Hello, everybody, and welcome to this cash flow hedge discussion. So Hart Golf uses titanium in the production of its specialty drivers. Hart anticipates that it will need to purchase 200 ounces of titanium in November of 2020 for clubs that will be sold in advance of the spring and summer of 2021. However, if the price of titanium increases, this will increase the cost to produce the club, which will result in lower profit. To hedge the risk of the increased titanium prices, on May 1st, 2020, Hart enters into a titanium futures contract and designates this futures contract as a cash flow hedge of the anticipated titanium purchase. The notional amount of the contract is 200 ounces. The term of the contract gives Hart the right and obligation to purchase titanium at a price of $500 per ounce. The price will be good until the contract expires on November 30th. Assume the following data with respect to the price in the futures contract. Okay. So when we enter in on 5/1/20, there's no cash paid. So what we have to do is we have to disclose this. And it would be something like Hart has entered into an agreement whereby Hart will purchase, whereby Hart has an obligation to purchase a minimum, or I should say 200 ounces. Okay, so obligation to purchase 200 ounces of titanium for $500 per ounce, and Hart must make this purchase by November 30th, 2020. You would have language, something to that effect. And so this is what you would go through and do on May 1st. Since there's no cash that's being paid out, we're basically kind of saying over here, it's like, all right, it is what it is, right? So it's just a disclosure, but you want to make sure though that the disclosure is robust enough that an investor reading the financial statements will understand what the obligations are. Okay, so now on June 30th, Hart is basically preparing its financial statements. And guess what? The value of this contract, which we'll be calling a futures contract, has gone up in value. And why is that? Well, it's because over here, this price is now $520 per ounce. So what is the value of this futures contract? Well, the 6/30/20 value is going to be 520. The purchase price is at 500. So the increase is going to be at $20 per ounce of titanium. So what I'm then going to do is I'm going to multiply this increase here by, we'll call this A, B, A minus B equals C. D, this will be the ounces of 200. So the value of the contract is going to be at 4,000. So I would debit the futures contract here for 4,000 because I have not purchased anything yet. This is going to be an unrealized holding gain or loss. Okay, and this is going to be for 4,000. And what you'll notice here is they're saying it's an unrealized holding gain or loss equity, meaning that it's going to be that separate component of owner's equity, or basically when we're looking at the other accumulated comprehensive income. Okay, so this is going to be on June 30th. And on June 30th, our financial statement preparation would be a debit to futures contract, credit to unrealized holding gain or loss. Okay. Now, if this was to go down, then we would actually have the inverse. It would be actually a liability, right? Because if the price goes down, we're still obligated to pay basically to purchase this at 500. So that would be a separate issue. Okay, but now let's move over here to September 30th, where we are preparing our financial statements once again. So here, so on September 30th, my spot price is now going to be 525 an ounce. Okay, my purchase price is at 500. So my increase is going to be here at 25. Okay, my ounces is going to be over here at 200. And so the value of the contract is now going to be 25 times 200 or 5,000. So the value now of this futures contract as of September 30th is going to be $5,000. So what do I need to do to balance? So my adjustment here on 9/30 is going to be for $1,000. And I'm going to put this over here to unrealized holding gain or loss on the equity. Okay, so that's how we've been gone through and we're doing this so far. On October 5th, 2020, Hart is purchasing basically 200 ounces of titanium at 525 per ounce and settles the futures contract. Okay, so over here, okay, on 10/5/2020, right? So I have a few things going on here. Okay, so when I'm settling the futures contract, right, meaning that, so what's going to happen here is that this now has to go to zero because I'm going through and I'm buying, in this case, it's the titanium. So I'm going to credit futures contract. And this here is going to be for 5,000. And then I'm going to be debiting cash over here for 5,000. So I'm going through and going through and settling this. The next thing I'm going to go through and do is to record the purchase of the titanium. So basically over here, I've got inventory. This is going to be 200 ounces times 525 or $105,000. Then I'm going to be crediting cash for that amount. So this is going to be 525, basically the per ounce price times 200 ounces. Or $105,000. Okay, now you might be saying to yourself, wait a second, Tchaikovsky, what's happening here, right? At the end of the day, the amount that I'm paying for the titanium, if we look at the cash, right, because I've settled this contract. So at the end of the day, the amount I'm paying is 500 per ounce times $200, times 200 ounces, or $100,000. So at the end of the day, the amount that I'm going through and recording here is at $100,000, or the amount of paying in cash is a net of $100,000. So this is what we're doing on October 5th. On December 15th, I sell clubs containing the titanium purchased in October for 250 grand. And then the cost of the finished goods inventory is 140. So over here, I'm going to be debiting cash for 250,000, crediting sales for 250, debiting cost of goods sold for 140,000. Now, the interesting thing here is that when you see this unrealized holding gain or loss on equity, and this is something I'm just kind of realizing now, what I'm going to do with this unrealized holding gain or loss is that I need to go through and to zero this out, right? So what I need to do over here is I need to zero this out once I'm going through and selling the items. So I'm going to debit the unrealized holding gain or loss on equity for $5,000. And I'm going to credit cost of goods sold. Okay. And that's going to be on December 15th. When you look at in terms of the income statement, the way it would show is that over here, Hart Golf. So you have sales revenue is at 250 less cost of goods sold is at 135,000. Gross profit is going to be at 115. The thing I need to say here, though, is that in terms of the cost of goods sold, you would say here cost of the inventory is 140,000 less the futures contract adjustment. And that's at 5,000 right up here, cost of goods sold. So that's how we're going through and looking at this particular question. Okay, so thank you all for joining me here today, and I look forward to seeing you on the next video. Have a great one.